All right. Okay. Welcome to today's class. Let's proceed. So, building upon market structure. Yeah. Every class we go a bit deeper into it. And even though in the conversation sometime I brush up on what we discussed previously, I keep saying that to get the most out of these classes, you have to watch and rewatch these videos because it is repetition that gets you forward in this thing. And then when you go to your charts, look at one instrument, look at volatility 25, look at 75, all of them. Check them out. Do the structure on one, do the structure on another one, do the structure. There are different time frames. Try to spend a lot of time, as much as you can, on this thing. The more you see it, that's one concept that was taught on. If you spend as much time going over it on the charts, it's called backtesting. The information you just got, go to the chart, try to, as much as possible, pin out, see how many times that happened so that you are beginning to train your mind to recognize these patterns wherever they appear and recognize these things where they appear. So today we'll be building upon market structure and pointing a few things that you need to look out for when taking your next trade. Yeah. So this is a structure. I'm going to use this to point it out for you. Yeah. So now this is your structure. Market has moved. You be assured that market is bullish, is going up, is breaking structure, retracing. Where should I be looking to take my entry from? Yeah. Where should I be looking to take my entry from? So here we introduce you to a tool called the Fibonacci tool. Now, this is a mathematical tool that calculates for you. It has done the maths. It is said that when market goes up, market will come down. When market comes down, market will surely go up again. So for this, uh, so let me draw it outside so that you can see it slightly outside. so that you can see it. Using this leg in price, as price went up, price retraced. You see that price retraces a good percentage and continues. Yeah. Now, when price moves and is complete, has gotten to a point of rejection and it wants to retrace, price would definitely retrace below 50% of that entire move. Let me do it like this so that it will be clearer. This is clear. So we're measuring the Fibonacci of this move. Now, your Fibonacci has a range of values. But for this class, we're only using 0, 50%. This 0.5 is 50%. This is 100. We're using 0, 50%, and 100. I will explain. Now, when price gets to a place of rejection and begins to retrace, we expect price to retrace at least 50% of this entire move. So whenever price moves, like we have already established, price doesn't go up forever. Price goes up and comes down. Yeah. Price goes up and comes down and goes up. Even when we are bullish, we will still get retracements inside. So to measure the retracement and know, okay, where should we be looking to take the most probable trade? We want to be finding our trades in zones where we call discounts, right? Our discount zones are where we want to. For instance, Bitcoin is at $100,000 right now. It is too expensive. Even if you have $100,000 right now, would you go and buy Bitcoin? You will not. It is not wise for you to be buying Bitcoin right now because it is expensive. It moved this price that you are seeing that Bitcoin is at now, 100, and I think as at today, let me see, currently, okay, 96,900. That's the current price of Bitcoin right now. It doesn't make sense for you to say, okay, oh, I have $96,000 now. Let me go and buy one Bitcoin. It is foolishness. There's no wisdom. You want to wait for price to come to a discount, this zone. It has moved, Bitcoin has moved this current price, it moved all the way from $17,000. It moved from 17,000 to 108. And then you want to buy it at 96. It's foolishness. Price will definitely drop. Bitcoin will still drop to like $40,000. So if you have 96,000, why not just keep it aside and wait for when price drops to like 40,000? Then you buy again. It might take a while, but you wait. It won't continue. Even if everybody is saying Bitcoin will get to $1 million, it might. But however, it's not going to move from 17 to 100 and from 100 to 1 million. Price doesn't move like that. It has moved from 17, moved from 17 to 30, down, dropped from 30, dropped to 85, 25, went to 45, 45 to 38, 38, 50, 50, dropped, stayed, down, went to 60, there was jubilation, dropped. That's how price moves. So whenever price is moving, you want to see it, okay, it's moving, it's moving, it's moving. Assuming you came and saw this move somewhere here, you wait. When it finishes the move, you draw your Fibonacci from the bottom of the move to the top. And you say, I will wait for this price, draw it, draw your Fibonacci, 0, 50, 100. And you say, I will wait for it further. When it drops below this 50%, I will now start looking for my entry to target this high. It will go above it, but your target is this high, right? So when price is at premium, we don't want to partake in it. We want to wait. This is where patience comes in this thing. You have to learn patience. When you start trading, don't get overly excited. Follow your rules dedicatedly. Follow your rules dedicatedly. So price is moving, has moved, wait for it. See, for instance, let me show you in real time example. Price has broken this high clearly. You see that it broke. It didn't continue. Sometimes it might push ahead, go above and dance and continue. But it broke above. If after price got here, you say, this price is going up and you buy, you will lose. See, it came back in. Now, let me show you. This is one move, one price move from here to here. Let's draw our Fibonacci. From the bottom of this move to the top of this move. You see that it came close to the 50% mark. You see, this is real time. This is the current price of volatility 25. I'm using this as an example. It came close to the 50% mark. Yeah, it will still dance. However, right now, it doesn't look like if you want to involve in this market, best to wait for it to come below this. You will get a better deal within this zone, within this discount zone than from here, because it most likely will still come inside here before it continues upwards. This is the entire move from here to here. See this one now. See this. This is one price move from here to here. Now let's check how far the retracement happened. Move from here to here. You see, it came below the 50%. After it broke this high. This is the high it targeted. Once it broke above it, it retraced below 50%. Down here and then started to change direction and went above it. Good trade. If you had waited to say, okay, within this, below this zone is where I'm looking for my entry, you wait. Once it got in this side, if you got involved, your risk were minimal. So even if it was going to continue, the distance from here that it stopped and changed direction to here is not much. So even if you were going to lose money, you won't lose as much as if, as this one is above the 50%, you get involved here and markets continue to drop and targets this low and breaks it and changes direction. Your risk is too much. You most likely will lose your entire account. So you want to wait for price to come into discount, then you take your position, right? That is one aspect of it. Now, when it gets into discount, what should I be looking for? It's just that, okay, got it got below this, it came. Is it that the moment it comes below this, I enter? No, you wait. There are certain parameters you are looking out for. Now, your Fibonacci doesn't just have, if you are using Fibonacci, first we'll start from Fibonacci, getting your Fibonacci values right. The Fibonacci doesn't just have um 0, 50, and 100%. Between 0 and 100%, there are a lot of percentages, right? We want to wait when it gets below 50% before we get involved. However, there are certain things you also add. That's where your 61% comes in. That's where your 70% comes in. Okay. All right. Let me do this for this example so that you see how far it reaches. Let's add the 50, 70%. Now, for this one, I hope I'm not overcrowding. Just follow me, yeah? We're using this to show the example, yeah? So it got below the 50% mark. It got below the 50% mark. So once it gets below this, it breaks below this, we start to wait for an entry. Yeah? We start to wait for an entry. You watch for the 61% mark and see, is there signs of retracement? You don't just jump in, say, okay, it's below 50%, I'm jumping in. No, you wait for certain signs. That is why your knowledge of structure is very, very important. Your knowledge of structure is very, very important. Market was coming down. However, this is 1 hour. This is the 1 hour time frame. However, when you go down to a lower time frame, you will see that markets begin to change direction here. Market will tell you that, here, I'm beginning to change direction. You will have confidence in it because it is in the zone of below, it is in your discount zone. Once you begin to see that, you will have more confidence in it. It might not work 100% of the time, but you have an over 80% success rate. And that's all you need in this space. You will take losses. Everybody loses. You can't have 100% profit every time you enter the market to make profit. Every time you enter, no, there will be losses. However, the goal is to have your profit overtake your losses. If you take 5 trades and your target is 1:3, 1:3 risk to reward, right? 1:3 risk to reward. So you are risking $5 to make $15. $15. That's your risk to reward. Yeah. You are risking $5 to make $15. If for instance you entered at this zone, yeah, your risk was $5. If it goes in your direction, which is you are bullish, in this case, you are bullish. So it went in your direction, you made $15. If it went against you and came down here, you lost $5. If it goes, you make 15. If you loses, you lose 5. If you lose one, if you lose two, you lose $10. If you lose two trades, if you lose two trades, 5 times 2 is 10. You lose $10. However, for one trade that goes in your direction, you have recovered $5. If you take one more trade, you've taken 2 trades and you lost. You now take one trade. It covers your loss. So if in a week you take 5 trades, no, you take 4 trades. Yeah, for instance, you take 4 trades. At the risk of 5, you lose at the risk of where's my X? At the risk of $5 each. Yeah, you lose 2. The writing is not coming. The thinking is more than the writing. Okay. If you take 2 trades, if you take 4 trades, so let me write it in full so that, yeah, if you take 4 trades a week, 2 losses equals $10 minus $10 minus $10. You have 2 profits, 2 wins, 2 wins. Your 2 wins, your target is 1:3. Each win is $15. You made $30. 30 minus 10. You are in profit for the week for $20. This is a 50-50. This calculation now is based on 50-50. You won 50% of your trades and lost 50% of your trade. You close the week with $20. You close the week with profits. So it's a fair deal. So when market got here, you were like, I'm bullish. So because of structure, of course, broke structure here. And judging by previous structures, this is what you've seen. The market is bullish. So you are bullish. So you wait here and say, okay, I will go into my lower time frame. Yeah, I'll go into my lower time frame and see if structure will give me confirmation. I'm already below, you see, this is the zone we marked. This is 15 minutes. We dropped from 1 hour time frame to 15 minutes. This is in our discount zone. We are waiting to see market tell us that it is beginning to change direction for market to begin to go up. So we get this. We came 60% didn't hold, 61% didn't hold. We came to 70%. 70% market showed a reaction. However, you don't get involved at this reaction. You wait for market to show you. You wait for a structure change. So market did this. Knowledge of structure, market did this. It came down, put a low, went up, put a lower low, and then broke it. You see? Are you seeing the structure? This is where your knowledge of structure comes in. And it did this. And continued going. So see why you have to understand structure. You have to understand structure. So let me draw it. Let me put it outside so that you see the structures better. See? This is what the market did. It puts a low, puts a high, puts a lower low, then broke it. Moment you see that, because you are bullish, you know that the market is, this is the confirmation you need to get involved in this market. This is all the confirmation you need to get involved and stay in. It retraced again, gave you entry, came down here to this order block. I am saying order block because I'm going to show you what an order block is. I already drew it. Came to this order block and bought and continued and has been going. Bullish. This would have been a very good trade for you. But I've made money. I wanted to make money. I came into the market. I saw this. I got involved and I made money. Simple. Your knowledge of structure, you combine with premium discounts. With this thing that I'm teaching you today now, I expect you guys, so far I've taught you, I've given you the basics, taught you market structure, how the structures are formed, the bullish, the bearish, the terminologies involved. You now know that. Now we've added this. With this now, you see this. With this now, you should begin to trade your demo. I'm not going to take another class after this class. Right now, I'm going to be answering questions and addressing your issues in your demo. With this now, you are good to go. You are good to begin to take trades on your demo. Don't fund yet. On your demo, follow it like this, draw it, wait for confirmation. You see it, you enter it. Next, okay, I will do class. Next class will just be on lot sizes. But with this, you don't just be entering with any lot size before the next class. Any lot size, whatever figure you feel to enter it because it's demo. Right? So with this, you are good. You should begin to trade because you have a working knowledge of structure. Go back and if you do your analysis and take your trades and you go back to the videos. In how many classes we've come to the point where you can place successful trades step by step. So once you have marked out your structure and you have seen this is the current price swing, you draw your fib. You draw your fib, your Fibonacci, and say, okay, I will get involved in this market in my discount zone. Once it gets into my discount, first thing you want to watch for. So elements of a trade, let me say that, let me write that. For you, elements of a trade setup for your level and for where you are and for these classes. Element of your trade setup. First is structure. First, you use structure on the higher time frame. Higher time frame. With structure, you will get your bias. That is bullish, you confirm whether bullish or bearish. Once you have that, we are bullish or we are bearish. Next, you take out your Fibonacci tool. Bring out your Fibonacci tool. I'm giving you the step by step. And you establish your PD arrays. Remember, PD arrays are your premium discounts. Premium premium discounts. Next, once you've established that, you wait structure shifts like we did here. So they call it MSS, markets structure shifts. You get this confirmation. It was coming down, then you got a low, a high, a lower low, then a break. Once you get that break, you begin to get involved. You get involved. So this is what you look out for when you go to your demo account to find your trade. You establish, check your structure, confirm your bias, you're either bullish or bearish. You take, once you establish that, you take from the current price leg, yeah? From the current price leg, you establish whether you're bullish or bearish. From the current price leg, you draw your Fibonacci tool. You wait for it to enter your discount. Then you wait for a market structure shift in your discount. In your discount zone, once you get a market structure shift, you get involved. You get involved. Now, once you get that, you get involved. So I mentioned here that it retraced to an order block before the market started to move. This is what an order block looks like. This is OB. That's a bearish. This is a bullish. Now, when the market wants to go up, it usually does something. The place where there are most orders, the accumulation of orders in a place that forces market to either go up or down. That makes the market to go up or down is called an order block. Yeah. So this is your order block. It might not exactly look like this when you go into the chart, but this is just um, to give you a visual representation of what it looks like. The more you look at it, the more you recognize it. So for a bullish one is the last bearish candle before a momentous move is your order block. For the bearish one, the last bullish candle before a bearish momentous move is your order block. Now, let me use this to show it to you. This one where we looked at. Drop to the 15 minutes time frame. This is your order block. This is your order block. This red candle. You see that after the red candle, do you see, does it look like the diagram I drew? After the red candle, there was a strong push upwards that went above the red candle. You don't just mark any red candle, but the one where the move happens, where you get your break. Yeah, that's why you wait for it. So it's not any red candle or any green candle before. It's not anyone. Where you see your break happens, where you get your market structure shift. Yeah, this is a break of structure, but in this case, the market structure shifts because market was coming down. You waited for it to shift. And we just say break of structure. So we add to the previous class, first of all. The more you go, you understand the market structure shift. But in this case, market was coming down. You got a low, a high, a lower low, and a higher high. So you will mark this place. The moment price comes to the top here, you get involved. Of this other block, you get involved. Because sometimes it might come all the way in, but other times it just taps into it and continues. Like in this case, it taps into it. So best thing to do, this is your long position tool. You take your trade. Would explain stop loss, lot sizes, and take profits in our next lesson. Or should we just do it in this lesson? Maybe. Let's just see. Okay. So the moment price taps into the order block, you get involved. This is a 4. Let's do risks to reward of 1:3. See, it's calculating your risk to reward ratio 3. So you get involved here. Your risk is $5. Remember, your risk is $5. I'm not saying it's always $5. I'm just using $5 as an example. You get involved. Once you get 3 times that risk, that if market had come against you here, you will lose. Once you get 3 times that, exits. Simple. Yes, market continues. Awesome. Another person's luck. You came into the market to make 3 times your risk. You have made that. Leave. Don't stay and be saying, hey, it's going, it's going. If you come back, you say, hey, I would have made more. Yes. Be right now. All you want to do is be diligent in just executing like a robot. Right now. That's all you need to be doing. When you have mastered it, you can now know that, yes, it will continue and go and go and go more than where it is now. Okay? But for now, this is all you need to be doing. You need to just be doing targeting 3 times your risk and get out of the market. You don't need more than that. Focus on that for now. For now. So you get involved, you put your stop loss below that low that broke the high. This is the high that was broken. This is the order block. You put your stop loss below this order block so that in case price retraces into the order block, you will still stay in the trade. Because sometimes it might come all the way here and then go up and continue. Okay, so this is it. This is what you need to get your trading career started. These basics. So you watch, you mark out, okay, this is the direction of the market. This is where I'm getting involved. It gets there, you get involved, you wait. And that's all. And that's all. Don't do too much. Don't do too much. So get into your demo trades and start to find these exact things from all the classes you've taken. And do that. And do that. Practice makes for perfection. The more you keep practicing, the more your process will get refined, and the more your mind and your eyes can easily see these things. And without thinking, you get involved in the market clearly, cleanly. Okay. All right. Elements of a trade. This is your systematic, this thing. You put your stop loss below. All right. I guess that is it for this class. I want to see you taking trades this week. Today, take at least, go into your this thing, take at least between now and weekend, make sure you've taken nothing less than 20 different trades following this system. Repeat, 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 rinse and repeat, rinse and repeat. Do this for this thing. Do it for 25. Go look for another this thing. Do it for another volatility 10, 10s, do it for 10, do it for 25, do it for 25 1s, do it for 51s, do it for 50, 75. Just be going. All you are doing is you are executing and executing. After a while, you don't have to consult your notes or the video because you would have worked it into yourself. It will be not just, I've given you the knowledge now, but however, you don't have the understanding. The understanding comes from repetition. You have the knowledge now. Knowledge, awesome. But with the knowledge, just the knowledge, you might still lose. But when you have an understanding of it, I'm not reading from anywhere to teach you this thing because I have an understanding of it. I know how it works. Once I come into the chat, I didn't look at this chat before I came. I said, okay, I will use this. It was just beside this thing. And when I turned, I started to use it to explain to you because it's always there. These things repeat themselves because market is cyclical. It goes up. Why will I be confidently telling you that Bitcoin will come down? And you will see it. Bitcoin will come down. Bitcoin will drop. It'll drop like 40K. Ehen. So to think that Bitcoin will keep going, so we might, the assumption is it is the next digital currency of the world. So it will keep going up. But however, it will come down first. It must come down. It must come down. Ehen. It must come down. Price doesn't go up forever. Price goes up and comes down. To make sure the structures are in place, price will always come back down. So the more you do this thing, the clearer it will get for you. So jump into your chart, find these things. From the first video, find your structure. Once you get your structure, you establish your bias, you use your Fibonacci tool. Once you get your Fibonacci tool and establish, okay, this is your discount, you wait for price to come into your discount zone. Once it is in your discount, you wait for a market structure shift. Once you get a market structure shift, you jump in. Jump in, stay in, get your profit, leave. 4 times a week, you find 4 of these trades every week, you are good. If you lose 2 and you make 2, you are in profit. Next week, you execute the same. That's it. All right, guys. I want to see your results in the group. We'll stop here. This is where the class ends for the day. Questions, any questions you have as you execute, any difficulties you have, drop it in the chat, drop it in the group, drop it. Let's address it. Now it's time for you to start trading. Jump into the chat and start trading. All right? See you guys in the next class. Bye.